Hey, Happy New Year, everybody. It's your boy, Corey McNabb. I know this isn't my usual. Typically on the YouTube, I'm doing the podcast, which will be restarting this year. My goal is to hit 100 episodes by the end of this year. As you know, all we're waiting on is number 50. Number 50. Unfortunately, not unfortunately, fortunately, my daughter was born a day early, which is why I was not able to get that 50th episode out, because I didn't have as much time as I thought to record the podcast. So, as you can see, I got the beard. This is probably the last time you're going to see the beard. I return to work soon, but that's not what I wanted this video to be about. Today, I want to talk about the things that I've been learning. So I set a goal for myself to the 52 books in 52 weeks thing. But I broke it down into each month. So this month, my goal was to read Becoming Your Own Banker, Richest Man in Babylon, Profit First by Mike Michalowicz, and The Psychology of Money. So I set up, okay, I get a week each to really work on it, work on these books. Well, I loved Becoming Your Own Banker. I started reading it maybe, what was that, the 30th or 31st? And I finished it yesterday. So, needless to say, it was one of my more favorite books, alongside Go Giver. That being said, I wanted to talk about what I had learned in that book. And of course, guys, if you're watching this and you know or have implemented the infinite banking concept, I want to hear from you. I want to collaborate with you, talk to you, learn more, because I'm just getting started in this and it's blowing my mind. Okay. So, and I also have to give a shout out to my brother, Bradley Lewis. We had a chat yesterday about it, and he's taking it even a step further, which is similar to what I want to do, implementing kind of the Rockefellers family bank system. But regardless, all right, so infinite banking. What is it? From my understanding and from what I've gathered from this book, it's utilizing whole life insurance policies that you emphasize the cash value rather than the death benefit. And so when you're emphasizing the cash value, what you're getting is the ability to then lend or utilize that cash value any point. Apparently in the contracts, the owner has priority. It is the owner's policy. So whatever that cash value is, you can then lend it out. I say lend, that's my method, is what I'm trying to do. What it talks about is basically paying for your stuff, right? You finance everything. Either you get a loan from the bank, whether it's a mortgage, a car payment, whatever. You're financing something from someone in order to pay for something, or you're paying cash and giving up the interest that you could make had you financed it from your own bank. So what it's talking about is using a whole life insurance policy to basically you take your income, whatever you make each month, and you put that in the whole life policy just like you would your bank. And that becomes kind of like your bank. Now there's a capitalization period. So as you start putting in premiums, you necessarily won't be able to pull out from it. And depending on, I guess I'm not super clear on this, but on the amount of premium that you put in determines when you can start pulling out of it, I believe. If you have more information, please reach out to me or put in the comments below and correct me at any point, guys. From that, you can then say you want to buy a car. If you've built up the cash value in your whole life policy up to the point where you can buy a car, you can pull that cash out and buy the car, right? Now, the big thing is you do not just want to pull it out as though it's a pot of gold that you can just take from. Okay, the point is not taking. The point is borrowing your own money. Okay, instead of going and borrowing someone else's money, you're borrowing your own money to buy that car. And then in your mind, you make the decision or sign a contract in your mind or even on paper to pay back what you borrowed from your account with interest. Now, don't pay less, okay? I know it's like, wait, that's my money. Why wouldn't I pay less in interest? Because you're accruing that interest, okay? That account is accruing that interest. So instead of being like, hey, since it's my bank, instead of getting and guys, I have no idea what car, we've paid cash for our cars. We've lost interest on that. But instead of paying whatever the interest rate is, let's just say 5%, that might be ridiculous. I don't know. That might be too low. I have no idea what the market is right now. But instead of paying that 5%, you're like, I'm going to pay 3% and save some money. But you're just reducing the amount that you would have recaptured. You're not recapturing all the interest that if you would have financed with someone else. So at minimum, match what the market rate is when you're paying interest back. Okay, you're going to build your own. You're basically creating a bank through the whole life policy. So now the book recommends, because it's your bank, you should actually pay more interest. So bump it up a little bit. He really digs into this when it comes to like self-insuring, right? So you're able to finance your car. Maybe you open another policy and you're able to finance your second car, right? After those capitalization periods and you go through it. Why not insure your car comp and collision, right? Now, basically, instead of paying whatever you would pay on a normal rate for a $500 deductible or whatever deductible you have, right, to your insurance company, just pay into your policy extra to get a $0 deductible. I'm still grasping it. So guys, if you need a chance to grasp it, think on it, rewatch this video, look it up, dude, get the book. It's Becoming Your Own Banker by R. Nelson Nash. Okay. I'll see if I can put the link to the Amazon page or whatever, if you want to use Amazon, or if you just want to go look for a bookstore, library. I'm sure the libraries have it. It's an old book. That'll be one thing I do say. This book is slightly outdated. And what I mean by that is not the concept. The concept is not outdated, but the metrics and the rates and the numbers that are used were written in 2000 and I think updated in 2008. Okay. So it's a little outdated with the numbers, but the concept is still valid. Okay. And it's been working. It's been valid for 200 years before when it was written, and it still works now. So like, a phrase that I just read in Richest Man in Babylon. Okay. It seems outdated, but the sun that's shining today is the same sun that shined then, and it's the same sun that will shine when your grandkids pass away. So there you go. Wisdom doesn't die, I guess. I don't know. Anyways, guys, if you like this video, if you like these types of content, let me know. I've got my kids running around. I'm sure you can hear them. This is unedited. Just throw it out there as I come up with it. So if you like it, let me know. Subscribe, like the video, comment below. I want to get to know you guys. I'm going to try and post more of this type of stuff. Tell you what I'm learning, because this year is going to be huge. Last year, I spent a lot of it learning. I still have more learning to do, but this year is all about implementation. So I state that out loud so that you will be inspired, but also help keep me accountable, and I can help keep you accountable. That being said, guys, podcast is going to be starting up back again soon, and I want to connect with more of you. So I'm going to put it in the description below, the link to sign up for the podcast. Let's get together. Let's get you on. You don't have to have any experience in anything, okay? This is a networking style podcast. If you have the desire to grow your wealth, especially through real estate, but even lending, or any business that you're trying to do, I want to talk with you. Okay. I want to learn your mindset. I want to learn what you're learning, and then let's see how we can do business together. Thank you so much, guys. Until next time.